Hi, in this video, I'm going to talk about how tips are taxed. So, we know tips are a type of the bond issued by the U.S. federal government. When a bond is issued by U.S. federal government, they are exempt from the state and the local income tax. Since the tip have the interest income and the growth on the principal, so both of them they are exempt from the state's and the local income tax. However, you have to pay federal tax on the interest and the growth principal. Also, this I will discuss it in detail later. So you just have to know that the inflation adjusted to the principal are taxed in the year in which such adjustment occur, even though the inflation adjustment are not paid until maturity. So let's see an example. Here is an example. Let's say today I spent $10,000 to purchase a tip. The tip give me a coupon rate is 4%. This is annual interest rate. Then the CPI inflation rate annually is 3%. The par value is $10,000. Then the term is 3 years. So in this example, let's see what's going on in each year. Let's say this is year one, year two, year three. So we have a CPI inflation rate of 3% each year. OID. OID is the original issue discount. So you just have to know OID is equal to the 3% inflation rate times the par value. So we'll give you annual the inflation amount. Then you use this, you add this amount to the original principal. Then you will get adjusted principal for each year. Let's say the first year is the adjusted principal amount is equal to the 10,000. You add the 300. The second year is the 10,000. 300 add the 300. And the third year, you add the 300 to the 10,600. So this is your adjusted principal. So how about your interest income? Well, your coupon rate, which is your interest rate, is 4%. 4% constantly for the 3 year. The first year, your interest income is equal to the 4% times the adjusted principal. So you get $412. So the second year, you 4% times the adjusted principal, then you get $324. The same for the third year is $336. So when you have this information, then okay, you know this is interest income, you will be taxed. However, even though you adjust the principal at the end of the end of the year 3, you will receive the principal is 10,900. However, during the first 2 years, you have to pay the income tax on the inflation adjusted amount. So, for the year 1, your taxable income is equal to the inflation adjusted principal amount $300 plus the interest income $412, so give you $712. So this is your taxable income. This similarly in the second year is equal to 300 plus 424 give you $724. This is your taxable income. So we just want to say this side the inflation adjustment to the principal are taxable in the year in which such adjustment occur, even though the inflation adjustment are not paid until the maturity. Now you see what does this mean? It means the a principal, your extra $900 is adjusted from the inflation, you will not receive this until the maturity of the year at the end of the year 3. However, the $900 will spread in the 3 years to be taxed, pay tax on it, which means $300 you even not receive it, but you have to pay tax. This kind of called phantom tax. So let's say your marginal tax rate for the federal is 30%. So then your taxable income is 712. So your tax is 213.60. So this is all your tax for the 3 years. Then you can see your tax on the inflation adjusted portion, which is the $300, is $90 each year. So this is on the inflation. I know the government tax you on the inflation. So basically, if you can see the year 1 return, you can simply the return is you get extra this money, then you divide it by, that's your income, increase income divided by 10,000, you can get the 7.12% for year 1 return. The total return, you just add all those numbers together, then you divide it by the original investment. So then you get a 21.72%. So if you divide it by 3, then you can get 7.24%. So this is kind of is your annual return before tax. So how about after tax? After tax, you just add those numbers together, you minus all the tax. So then you get a number, then you divide the number by the 10,000. So then you will get this total tax return rate. So the annualized return is 5.07%. So you can see you this really affect you on the tax day, because they taxed on the principal adjustment amount as well. So for the strategies, if you want to buy the tip, so it's really you can invest the tip. You can invest the tip in your retirement account, such as IRAs or Roth IRA.